Welcome to Mind Your Money. I'm Brad Smith, and this is Yahoo Finance's flagship personal finance show. Think of this as your financial toolbox. For the next 30 minutes, we'll cut through the jargon and tap into expert advice, all designed to help you take control and build a stronger, healthier financial future. This week in Your Wallet, we discuss future rate cuts and what a lower Fed funds rate means for your mortgage and your debt. And your mid-year financial check-in will review tax-efficient strategies that you'll want to capitalize on. Plus, getting retirement ready. Yahoo Finance will answer all of your questions relating to required minimum distributions or RMDs. You don't want to miss it. Well, Federal Reserve officials are split on whether an interest rate cut in July is on the table. Depending on whether the FOMC holds rates steady or reduces the benchmark rate, what does that outcome mean for your everyday finances? Here to explain and discuss further, we've got Rob Conzo, who is the Wealth Alliance CEO. Rob, good to have you here with us. How does the Fed's benchmark rate affect people's personal finances?
Great to be with you, Brad. It's a very misunderstood rate. It's the rate that banks charge each other to borrow money, but how does that affect you personally? Well, first thing, it affects you either way. Number one, on the expense side, meaning borrowing. So we all know that, right? We have mortgages and credit cards and auto loans and student loans and small business loans. So when the Fed sets a rate, right now it's between 4.25% and 4.5%, well then all the banks look at that rate and decide where they're going to charge you for the debt side of it, your expense. And let's not forget, half of the American economy is small business. So when they have to pay more for lines of credit and loans, well, it hurts them, they hire less, and it's a problem for the economy. So that's why everybody wants the Fed to lower rates.
So Rob, let's get specific. How are mortgage rates impacted by the Fed's next move? And does a cut mean that we could see lower mortgage rates as well?
Yeah, so the longer you go out with lending, the longer other factors are involved. I'll give you an example. Let's talk about money markets. That's money you're earning. Well, that's every single day, and all that matters is what the Fed is going to charge and what the bank wants to make. And there's a rate. A mortgage, money, expense you're spending. Well, that's different. Now suddenly the bank goes, all right, let's see what the Fed is going to charge, 4.25%. Okay, now you want to get a mortgage. So the Fed rate is one aspect. How much of a mortgage is the second? How long are you going out? What's your salary? How the house is valued at? So the longer the debt, the more Fed rates, the more your personal stuff gets involved and muddies the water between just the Fed rate. So the Fed rate is just a little part of it when you're going out longer.
You know, while we have you here, now let's go to credit cards. Say, maybe not me, but somebody I know has a lot of debt and racked up here. Will a lower benchmark rate from the Fed mean that I have to pay less interest, perhaps?
Great question. The credit card one is the one that's a little unique in the sense that credit card companies charge upwards of 15, 20, 25% in interest. And you're saying to yourself, well, how could it be so high? And it's so high because credit card companies want to make a lot of money. So at the end of the day, there's so much leeway in the credit card company. You would think if the Fed lowered rates, you would see credit card rates come in as well. That may not be the case. Some credit card companies just hold it steady. And it is what it is. Give you another example. Sometimes, forget credit cards, again, when you're at a bank savings account and you're getting very, very little interest rate, but yet the Fed's rate's at 4.25%, 4.50. Why is that the case? The bank has the right to say, look, we're only going to give you 0.2%. Meanwhile, another brokerage account could give you 4% on a money market. So there is business parts of what the interest rate you pay or you receive on top of the Fed rate mandated.
What about savings vehicles like CDs, certificates of deposit? How are they impacted depending upon the Fed's decision?
So CDs, savings vehicles of all sorts, money markets is a standard one, bank savings accounts, people know. Again, there's two aspects of it. Fed, surely, if the Fed raises rates like they have, well, then you're going to typically get more in bank savings accounts and CDs. And we've seen that. People getting 5% in CDs. The Fed starts lowering rates if they do, and we don't think they're going to be doing that this July, but a good chance they could be doing that in September. The Fed starts lowering rates, you'll see those CD rates and savings rates come in, and that's why a lot of financial advisors are saying, hey, you may want to lock in a longer rate now while it's still high before the Fed cuts.
And finally, while we have you here, Rob, when the Fed finally cuts interest rates, should you adjust should you adjust your financial plans, things like your budget or borrowing, or should you just stay the course?
Now, it's a very good question, and it depends, really. And a lot of answers to financial questions are, it depends, unfortunately. But the real answer is, when the Fed starts cutting rates, if it's just very, very minimal, a quarter of a point, that's not going to make a big difference on things. But as things start to go down further, if they do, well, then you want to start preparing for that now. You want to get your financial plan in order, understand how long your debt is going out. Are they credit cards with really high interest rates? And on the income side, are my income vehicles, bonds, CDs, savings accounts, giving me the interest that I need to make my retirement and financial goals?
Rob, thanks so much for taking the time here. We're going to be watching closely, as we know that you will be too, for when they do start to cut interest rates. Thanks so much.
All right. Thank you.
Well, we've got a slew of housing data this week, and the key word that we can read through a lot of it is slowing. While pending home sales picked up slightly in the latest report from the National Association of Realtors, the NAR, it remains subdued compared to pre-pandemic levels. Existing home sales saw their slowest May since, get this, 2009. Where were you in? And new home sales, they sank more than 13% from the month prior. All of this comes as mortgage rates remain in the high 6% range. For more, I want to bring in Yahoo Finance senior housing reporter Claire Boston. OMG, Claire, what does this all mean for home buyers right now?
Yeah, Brad. So when I look at this data, I am reminded that we're looking at May figures. May is historically the peak of the peak spring home buying season, and yet we are seeing very, very slow growth. And so what I'm thinking here is that home prices are probably going to have to fall. When nothing is moving, that tells me that sellers and buyers are not agreeing on anything right now. And as a result, if sellers are pricing too high and buyers are walking away, probably prices will come down a little bit. That being said, people might be kind of waiting for that 2009 moment, this big drop in prices, and no one that I talk to is expecting that. Generally speaking, what I hear is potentially nationally we could see home prices fall down, 1 to 2% this year.
What about those looking to refinance? Like, should they be waiting for those rate cuts that markets are pricing in right now?
Yeah, a huge part of the affordability story right now is mortgage rates, because they are quite high. And unfortunately, mortgage rates do not react directly to what the Fed is going to do. They are influenced by expectations about rate cuts, but oftentimes we see mortgage rates fall before the Fed does anything. So generally speaking, trying to time the market is not really a winning strategy for mortgage rates. We've been stuck in this kind of 6.8% space for almost all of this year. And some people say that rates could drift lower this year, but we're talking, maybe down to 6.7 to 6.5. Nothing really drastic unless your mortgage rate is really high above 7% right now.
Claire, I want to talk about something else that you're also reporting on, and that's the slowdown that we're also seeing in new construction here. What can you tell us on that front?
Yeah, so we were talking about how new home sales just really fell through in May. And what we're seeing is that builders are reacting to this data. They are building less. And so that is bad news long term. We know we have a shortage in housing in this country. When builders build less, that means long term, prices may stay higher. That being said, right now, builders have a ton of homes that they are having trouble selling. They are boosting incentives. They are buying down interest rates. They are giving people free upgrades. So if you are looking at that kind of new construction option right now, it may be a good place to get a little bit of a deal in this crazy expensive market.
Claire Boston, thanks so much, tracking all things homes. You can scan the QR code below to learn more about mortgages on the Yahoo Finance website. Well, we're about halfway through the year, and it's time, perfect time in fact, for a financial health check-in. Joining us now to discuss tax-efficient strategies that you should make to make sure that you're taking advantage of is Rob Williams, who is the Schwab Center for Financial Research Managing Director of Financial Planning. Rob, good to have you here with us. Within Schwab's
Good to be here, Brad.
Certainly. Within Schwab's 2025 Wealth Management Mid-Year Outlook, you talk about tapping the full range of tax-advantaged investment accounts that might be available to you. We're talking IRAs, 401ks, Roth accounts, and HSAs. Let's just start perhaps with how a traditional IRA can help your tax bill.
Sure. Well, one of the things I want to start with is we can't control markets. They're volatile, they go up and down, but we do have some control over taxes. And these tax advantaged accounts are really one of those vehicles we have to do that. And IRAs is one. And one of the advantages is pretty much everyone has access to one. So if you have earned income and you don't exceed certain thresholds, you can contribute to an IRA up to $7,000, $8,000 a year if you're over age 50. And that money can grow tax deferred. It's pre-tax, it's tax exempt, then tax deferred. So, that depends on your income level, but that's really one of the first tools that many of us have. Almost all of us have access to it, and it gives us those tax advantages of saving and really building wealth over time.
Rob, what are some of the tax-efficient strategies that you should be considering mid-year within your 401k?
Well, continue to contribute. That's the first. We mentioned IRAs, we started with it, but anyone who has a 401k, the contribution limits to that are higher. You're going to get an employer match that's required by law, can be up to 50 cents on the dollar for 6% of your contributions. And it's really earmarked for retirement. So that's free money from your employer. Get the match. Continue. I don't like to use the word autopilot, but you can take it from your paycheck. Continue to start small, but continue to build. So mid-year is a good time to look at what your contribution rates are. Think about whether you can increase them. You may look at your asset allocations and things too, but even that is something you maybe do once a year. So make sure you're contributing. Can you afford more? Continue to increase. You'll thank yourself later as your balances continue to grow.
Now, we talked about and started to talk about an IRA. What about a Roth IRA?
Right. Roth IRAs are great. I love them. They're one of the ways to sort of bite the bullet up front, meaning that unlike a traditional IRA or a 401k, you pay tax up front on that income. Then you contribute it to the Roth, whether it's a Roth IRA or a Roth 401k. And then after that, any growth in that funds in an IRA, the Roth, or your withdrawals are tax-free. So we're all watching the tax rates, watching what's going on in Washington. But whatever happens in the future, you're avoiding and then sort of saying, I'm not going to have to pay tax on those savings and any of the earnings in the future. That's really a powerful tool, and it's one of the other accounts you have in your toolkit to make sure you have a tax-aware account strategy.
And then finally, we got to talk about this, an HSA. I mean, there are so many different strategies that we've heard about this over the year, but a health savings account, what's the mid-year check-in strategy for folks?
Well, I said Roths are my favorite, and now you mentioned HSA, so I'm going to change it. They're one of my favorites.
You can't do that,
too.
Rob. Can't do that.
Yeah, okay. There are a lot of favorites, and there's a lot of things on the menu, but HSAs, you can get them through an employer if you're in a high deductible plan, but here's the key, they're triple tax exempt. So you can contribute money up to, their limits aren't high, but they're reasonable. Invest in that account, and then any withdrawals you take for retirement or for healthcare expenses at any point in the future, you can grow that money as tax exempt too. So at all 3 points, there's no taxes. And here's a nice kicker too. After age 65, you have earnings are taxed if you take it out for retirement, but it becomes a bit like an IRA account. So I think of them sort of as that wild card account to use to help manage healthcare costs, but also build those assets to be flexible once you get to retirement.
Okay, I lied. That's not my last question. Just put all of this together for us, though. What can people do today in regards to their tax-advantaged accounts to put them in a better position for the back half of the year and for longer run savings?
Well, have a hierarchy. That's 4 or 5 different accounts I mentioned. The first is to save, use those vehicles, even if you start small. Second, use your 401k first and the health savings account. Those are really powerful ones. Get the match from your employer. Some health savings accounts offer that as well. Then after that, you have more choices in terms of where to go from there. Contribute more to your 401k, considering a Roth or an IRA. Those are all things you can think about on your own, or work with a financial planner or a tax professional to help you work through that hierarchy. The key is to be on it. Time's on your side. We want to make sure we build wealth and we keep it after tax. That's really the name of the game.
Rob, great to see you. Thanks so much for joining us here on Yahoo Finance.
Thank you.
You can scan the QR code below for more tax content on the Yahoo Finance website. As you invest over the course of your career, you will hopefully build enough wealth to support yourself in retirement. That is the goal. But as you get older, you will eventually get to the point where you need to take required minimum distributions. That means you must withdraw a certain amount from your retirement plans with tax-deferred contributions. That includes your IRA, your 401k, and 403b. You must take your first RMD by April 1st, the year after you turn 73. You will then be required to take another RMD by December 31st that same year. And then you will be required to take additional RMDs every year. If you don't, you may have to pay a 25% tax on the amount not distributed as required. But that's just for the current batch of retirees. For those who are born after 1960s, well, yeah, after 1960, for those birth dates, you won't be required to take your first RMD until you turn 75. In order to calculate a required minimum distribution for a single IRA holder, you take the total balance by the end of the previous tax year and divide it by the IRS's life expectancy for your age. For example, if you turn 73 in 2025, the IRS thinks you will live an additional 26 and a half years, making the required minimum distribution on savings of $200,000 just over $7,500. The calculation can vary depending on what type of accounts that you have or the age of your spouse. So make sure to check with your financial advisor. You can also scan the QR code below to find out more about RMDs. Well, we're going to help you get retirement ready and talk about required minimum distributions, known in the personal finance world as RMDs. And today, you ask the questions in Ask Finance Everything. Ask Yahoo Finance anything. We have a whip-smart team to answer your RMD questions. And joining me now, we've got Yahoo Finance senior columnist Carrie Hannon. Also with us is host of Yahoo Finance's Decoding Retirement video podcast, Bob Powell. Carrie, let's start with you. Just first, from all the folks writing into you, what's the thing that confuses them the most about RMDs?
Yep, Brad, I'd have to say the big one is like, when do I have to take them, right? It's confusing for people about, when the specific thing. And as we discussed, it's, April 1st of the year following. If you turn 73 this year, it'd be next April. But you can take them by December 31st this year. If you turn 73 this year, you can go ahead and take it by December 31st. That's what really trips people up. But here's the beautiful thing is, to tell you the truth, you don't really have to do this on your own, do that calculation. Generally speaking, your financial services company, where your IRA is or your 401k, will do this calculation for you. And they will usually let you know by the end of December what you're going to have to pay out that following year. And you can make the decision. Do I want to automate, do I want to automate it? How often do I want to take money out of the accounts? And should they go ahead and withhold the taxes for you? And most people will say, yeah, go right ahead and do that. There is an exception to this, Brad, that I like people to remember, that if you are still working at the employer where you're paying into that 401k plan or what have you, you don't have to take your required minimum distributions in general until you do retire. So that's one exception to this. But really, that's what trips people up. So again, reach out to your accountant, talk to the plan administrator where your money is, and they can help you work through this.
Carrie, one of your readers wrote to you and asked, the stock market was up last year, and so were my retirement accounts. Will my RMDs be the same or more than last year?
Sorry, Charlie, they're going to be more. It's the thing is, that's the point, is higher returns on your investments translate to higher RMDs, because we discussed that calculation. It's how big your account was at the end of December. So that's what you're going to pay for 2025. You're going to be based on what your account was worth at the end of 2024. So, the S&P was up, what was it, something like 23%. So yes, indeed, they will be a bit higher, but that translates because you did really well last year.
Bob, turning to you, a topic that you're interested in is a new rule regarding RMDs when someone has multiple IRAs and wants to do a Roth conversion. So what is the new rule and how do people navigate it?
Yeah, it's a wonder why anyone owns an IRA, Brad. But here's the final regulation. It states that all of your IRAs are now viewed as one giant, massive IRA for RMD purposes. Now, historically, you could satisfy the RMD for a specific IRA and then convert any remaining funds in that IRA into a Roth. But under the new rule, all of your aggregate RMDs from all of your IRAs must be fully satisfied before any distribution from any IRA can be converted into a Roth IRA. And if you convert money from an IRA before you do all that, you could be subject to a 6% excess contribution penalty on the improperly converted amount.
Bob, got another one for you here because, it's about the 10-year rule with IRAs. People who inherit an IRA from a parent or other relative have to empty that account within 10 years of their death. But how the money is taken out during those 10 years, it differs around whether that person had started taking RMDs. So can you please explain these scenarios and tell viewers what they need to do?
Yeah, I'll try and simplify it, Brad. So the new final regulations clarify the distribution requirements during the 10-year period. It depends on whether the original IRA owner died before or on or after what's called their required beginning date. So if the IRA owner died before their RBD, the beneficiaries do not have to take any RMDs during years 1 through 9 following the owner's death. They simply have to empty the entire account by the end of the 10th year. Now, if the IRA owner died on or after their RBD, they have to take what's called an annual stretch distribution during years 1 through 9, and then take out the remaining balance by the end of the 10th year. So it's a little complicated because we've now added another acronym into the mix here. In addition to RMD, we've added RBD into the mix. So my advice would be it's best to talk to a professional if you inherit an IRA.
Carrie, I got 30 seconds or less. Another one of your readers asks, can I use my RMD to make a charitable donation? What say you?
Yes, indeed. If you are charitably inclined, absolutely, you need to make that. It's called a qualified charitable distribution. The money needs to go directly from your IRA or your account to that nonprofit. Don't come to you, go straight there. Make sure your accountant knows about, so it's not counted as income, and that money doesn't get taxed. So yeehaw, you make a big bang with your buck with that nonprofit, and I think it's a wonderful thing. There are some limits. I think it's up to $100,000. You can do that. IRS has a few things around this, but it's really a great option for people.
All right, AMAs ran, so AYFAs could sprint here. Ask Yahoo Finance anything addition with Carrie and Bob. Thank you both so much answering some of those key burning questions from our viewers and readers. Appreciate it.
Thanks, Brad.
Thank you, Brad.
That's it for Mind Your Money, everyone. Guess what? You can scan the QR code below to sign up for the Mind Your Money newsletter. You do not want to miss that when it drops and hits your inbox and online. You can stay tuned for Market Domination coming up next.